I know a lot of you out there love the idea of dividends, and the idea that companies pay you money just for holding their stock definitely sounds good. But have you ever thought about whether or not those companies who pay out dividends are actually worth it in the long run? And are they really the companies that you want to hold during a market crash or a correction? Could they be the answer, especially if you're sat out of the stock market at the moment, clinging on to all of your cash as if you just won the golden ticket to the chocolate factory? I always see lots of videos on YouTube talking about dividend investing and different stocks that pay out lots of cash, but I don't see anyone discuss some of the downsides or really look at how dividend-paying companies have actually performed during times when we've got a recession or when things are looking pretty rough, just like we do have now in 2022. So let's go down the rabbit hole and really see if dividend investing is the way forward. Is this the hack that we need to make money through this crisis, or is it just another distraction for long-term investors who should just stick to index funds? Let us begin. Now, I think the only place to start with dividend investing is to do what every good detective should do and follow the money. Where do these little gifts come from that we get delivered to our investment portfolios? Because you can't grow money on trees, at least the last time I checked. Ultimately, dividends get paid to us from companies that we own in cash. So in theory, that means that we end up getting a little bit of those profits that a company makes. Just take the example of Coca-Cola, one of the companies that has a track record of paying dividends for decades. Every time you buy a can, a bottle, or even a pint at your local pub of that famous sugar water, that money eventually flows all the way back to the business, gets turned into revenue, which once you remove all of the costs of making it, becomes profit. And then eventually out the other end of the big machine comes your dividend, which is paid per share. So the more shares you have, the more money you can end up with. Okay, so that all makes sense. A business makes profit and then takes part of that money and pays it out as a dividend to shareholders. And then from that position, you can do with it basically whatever you want. You can take it and spend it and buy more cans of Coke. You can reinvest it back into the business itself, or you could take it and invest in something else. It sounds great in practice, but let's not forget that nothing is guaranteed here. Investing is always risky, and companies can and have stopped paying dividends many times before, even at really short notice. Now, as usual, we can never know the future, but we can look back at the past and see how companies have done through previous recessions and market crashes to see if they have in fact performed better, especially when compared to other companies who don't pay a dividend, as that's what we really want to know. Now, unfortunately, I'd probably need some paid data subscription to get all of that information, but here's something that's really interesting. Around 400 of the 500 companies in the S&P 500 do actually pay a dividend, even if some of them are only small payments. And then closer to home in the FTSE 100 here in the UK, this year we're expecting to see 97 of the 100 companies pay a dividend. And that's an improvement from 91 the year before, and then 85 back in 2020. So dividends aren't just reserved for a small number of companies, they're actually a big part of the total returns of the stock market. Now, luckily, that data is quite easily available, and we can see what effect having no dividends would have caused over that long term. So check this out. From 1960 up until last year, if you had invested $10,000 and then just left it, I don't actually need to do any currency conversions anymore because it's pretty much level pegging at the moment. Anyway, as you can see on screen, the difference with dividends is pretty crazy. With everything poured back in, you end up with almost $5 million, which, when compared to just $795,000 without dividends, just shows how important not only dividends can be, but then the power of reinvestment and getting them to compound. But what about being recession proof? That's what we really want to know, right? Well, this one's a little bit tricky to figure out. It really all depends on where we want to look and what you want to compare things to. If we break down what happens in a recession or a market crash, we're probably seeing a few things happen all at once, like companies laying off staff, higher unemployment, people having less money to spend, and businesses also cut back too. So generally, you'd probably agree that people will only have to spend money on things that they need and a lot less on nice to haves. There'll be less money as well to fund new businesses, certainly ones that lose money while they're trying to build themselves. So that means that we're looking for certain types of companies to invest in to get us through it all. If we go back to Coca-Cola as an example, I think it's definitely fair to say that you don't need cola to survive unless you're Warren Buffett or one of those crazy people who drinks 2 litres of Diet Coke a day. However, even during a downturn in the economy, they do make a product that's still something people want, and they'll have it as a treat out for dinner, at home, or away at the cinema, even if they go out a lot less than they would have normally done before. And let's just quickly check if that's true. If we have a look here and find Coca-Cola's financials, the ticker symbol is KO. Now, let's look at their income statement. How much did they make in revenue during the Great Financial Crash? And then maybe let's have a look too around the dot-com bubble. Okay, so the Great Financial Crash all kicked off around the middle and the end of 2007, obviously pushing through to 2008 and 2009 when it bottomed. So Coca-Cola's chart looks pretty stable then. They actually made more money in 2008 than they did in 2007. And sure, you did see they did have a slight dip in 2009, but then they were back up again just a year later. And let's also check during the dot-com bubble. The market peaked in the summer of 2000 and then went down from there for a very long time. And Coca-Cola pretty much stayed flat with a small decline, but nowhere near what the S&P 500 did or the wider stock market. And now finally, the big question is, did they also continue to pay out dividends? The answer, yes, no drops at all, and they actually increased their dividend throughout both of the last major recessions in the stock market. Okay, cool, so that just means that we all buy Coca-Cola stock and everything will be alright in the end. Well, maybe not so fast, because as usual, the answer is a little more complicated than that. Other popular dividend-paying stocks haven't always been as consistent, and there's been plenty of times that dividend-paying stocks have stopped paying out all of a sudden. Even during 2020, lots of companies, at least here at home in the UK and the FTSE 100, cut their dividends or stopped paying entirely. In fact, the total paid out fell by more than 40% in 2020 as companies scrambled to try and figure out what the future was about to hold. Some companies did manage to keep going but had to readjust things pretty quickly. And take Shell, for example, the oil company. It's one of the biggest dividend payers on the index, and it cut its dividend payment by more than 60% in 2020. So just to note that nothing is guaranteed in this investing world and dividends aren't protected in any way at all. Just remember that. Anyway, if we're going to choose some companies that are going to be reliable, then we have years of data that we can look back through to show us which companies have actually been reliable in the past. Because although we don't know the future, if a company has survived for a long time and been consistent paying dividends, then there's a pretty good chance that it's going to be strong enough moving forward to survive. Now, rather than trying to work out what companies to pick and choose, let me show you a couple of places you might be able to look where the hard work has already been done for you. If you're looking for reliable dividend-paying companies with great track records, look out for dividend aristocrats and dividend kings. Basically, you've got groups of companies that have paid out a dividend for either 25 years, in the case of the aristocrats, and then 50 years for the kings, which is definitely quite an exclusive club. In that exclusive club, there's currently just 41 companies, and that includes the likes of Coca-Cola, Johnson & Johnson, and 3M. Clearly, if companies have been able to pay dividends and get through more than 2 decades, then they've got through both the financial crash and the dot-com bubble and survived to tell the tale. Now, whether or not they can get through any future crashes, that one's always an unknown, but the point still stands that companies that pay out dividends reliably do tend to be the ones that have got the power to get through those downturns. They're less likely to fall apart when interest rates rise all of a sudden, and they also tend to be profit-making machines that all sell products that we need as consumers and also needed by businesses almost no matter what happens out there in the world. Okay then, so how do we decide what to invest in, and have they actually beaten the market? Because surely we should just stick to our old trusty index funds instead. If I run the S&P 500 against a high dividend ETF from Vanguard, say that we put a lump sum of $10,000 and then contribute $200 per month for as long as possible with everything reinvested, here's what it looks like. As you can see, the lines are pretty close, and this goes back until 2006. And this is really because the high dividend stocks, at least in this example, are also part of the S&P 500 too. So companies like Johnson & Johnson, Home Depot, and PepsiCo, they're all part of the larger index anyway, so it's no surprise that they move pretty much closely together. You have to bear in mind that the S&P 500 as a whole does actually pay out dividends, and although it's not a huge amount, it's still going to make a difference, as we've said in the chart before at the beginning of the video. Also, what this chart does show is that you can't hide from crashes. Sure, you can pick individual companies and sectors which might do slightly better during a crash like we did with Coca-Cola, but their share price is probably still going to fall with the rest of the market. The bottom line is that by trying to pick stocks to beat the market, you still have the same challenges as everyone else does, in that it's extremely hard to do it over the long term and do it successfully. And also, just a word of warning here, but you also need to be really careful with some dividend paying stocks that look to be paying out a really high dividend. If it's too good to be true, it usually is, and you need to consider more than just the dividend yield if you're going to be investing for the long run. A good example are tobacco stocks, which have paid really generous dividends of about 8% a year, but then at the same time, if their stock price has also been falling, then you end up no better place than you started. Don't forget that if you invest £1,000 into a dividend-paying company who gives you back 8% a year, you might get £80, but then the share price could drop 20% during that year, meaning that in total, rather than having £1,000 you started with, you've got £80 as a dividend and then £800 left of value in your stock, so a total of £880. Obviously, you'll want to think about the kinds of sector that the business is in. Think about whether or not it's one that's going to grow, and be careful about what you end up paying for the stock. Just like anything else, share buying at the right price can really make the world of difference. Now, with all of that said, I think it's worth saying that with all of this, it depends on what you want as an investor. Dividends can be really good to see go into your investing account, and they can be pretty exciting to watch build up over the years as they gradually compound and you keep investing more and more cash into your account. But they could also just be a distraction if you're a long-term investor and your goal is just to have as much wealth as possible at the end. If you had stuck to a low-cost index fund rather than a set of dividend-paying stocks, you might actually end up better off rather than trying to chase the short-term gains. Oh, and also don't forget that dividends can be a bit of a tax headache, so just be careful with them. If you aren't using a tax-protected account like a stocks and shares ISA, then you'll have to check to make sure that you don't go over your allowance. Otherwise, you will have to report them to the taxman, which could be a pain if you did manage to build up quite a nice pot. Now remember, I'm no tax expert or financial advisor, so please do seek help if you need it, but that's just another thing worth bearing in mind. Now, just as an example, let's just say that you were looking for income that you could actually spend and you wanted to use dividends as part of a wider strategy, then sure, this could be one way of doing it. You could have a nice, well-diversified set of stocks who might all be dividend aristocrats or kings with a proven track record, and then just decide you're only going to spend your dividends and just leave everything else to ride. I think long-term that's something I'd love to do and have a portfolio that I wouldn't even have to sell and just let the market decide if it's been a good quarter or a bad one and then adjust my own spending from there, but we'll see if that actually ends up being the case many years from now. Oh, and just before we wrap this video up, I did want to highlight that rather than having to pick individual stocks that pay dividends, you can quite easily buy ETFs which already focus on dividends and giving you an income. If I just pull up my Trading 212 app here and go to the search bar, I can type in UKDV, which is actually a popular ETF that specifically follows the UK dividend aristocrats. Or also another really popular one I know a lot of you already use is VHYL, which is Vanguard's all-world high dividend yielding ETF. And that's in case you wanted to go global and invest in many more companies. By the way, if you do want to get started investing, I always have the links below in the description with any offers available. If you want to get a free share or even some cash to get you started, don't forget to check them out below. So the question then is really up to you. Yes, dividend investing can be reliable, and yes, sure, some companies can help us get through crashes better than others, but we could also do the same with pretty much normal index funds. One thing I would say is that changing your portfolio all the time to react to current events definitely won't get you anywhere, especially in the really long term if you're a long-term investor just like me. Anyway, just for some fun, let's see if we can make some magic happen. Let me know in the comments if you're going to index and chill or dividends and thrill. I really hope that works in the edit, otherwise I'm going to look really stupid. Anyway, drop me a like if it did, subscribe for more, and as always, happy investing.